Markus Helsing of Alpha Broking, who's live in our Melbourne studio. Markus, great to see you there. Markus, is that you? Almost didn't recognise you.
It is.
Fantastic to see you there.
No beard.
Thanks so much for joining us. Now, let's talk copper. We mentioned there it's retreating somewhat, but we have spoken to you before, and overall you've maintained your sort of bullish technical outlook. Is that still the case?
In short, yes. I think I have to correct some of my earlier statements a few weeks ago when I was probably a bit too conservative, in particular when we talk about iron ore, coking coal and all this type of prices that really affect the Australian economy most directly and the Aussie dollar. Really, the copper factor is really lagging and it's finally come to the show. And I think fundamentally already mentioned the potential strike action, if not already in action, further underlines support. The technical picture on copper is outright bullish in a strong way, targeting levels in a 325 cent a pound level, in our view, potentially over the next 3 months. This could all unfold very quickly, and I think, again, this is a tremendous sort of Goldilocks scenario for Australia. I think the iron ore price at $82 a tonne with a backwardation or forward pricing at $16 1 year out, still, while shrinking, still relatively large. But if we hold around these price levels, any months we hold here, let alone a whole year, it will be tremendously beneficial to the Australian economy in terms of trade figures, as today's release has very much shown what's going on here, and that's really a direct result, of course, of the rising price that we get. So our terms of trade is improving significantly, and that's, of course, a major impact on the Aussie dollar. And I want to mention that because this is really now coming to the party. Only 5 weeks ago, long-term forecasts were in a 65, 68 or 70 territory on the Aussie. We probably now see them starting to be happy at 75, most likely changing this forecast to 80, 85 cents on this type of Goldilocks commodity scenario.
Markus, it's Rudy here. Happy New Year, Markus. And also,
Happy New Year, Rudy.
You might have fooled the other people here, but I know it's not you, Markus. It's your younger brother. Anyway. Anyway, Markus, I'm interested in your views on crude oil and maybe in extension of that in gold.
Well, it's a different story. I think, speaking of oil, it is range trading. We're still a bit wary. If you look at the price action, natural gas, it tends to move a little bit ahead of crude oil, indicating, and to us, a potential of a correction back to $48, $50 in crude oil. It's also a little bit of a hopeful or wishful thinking to allow us to reposition. If you look at international oil stocks in a moment, your Chevron, Exxons and Royal Dutch, they've run out of puff, and as a matter of fact, they're looking a little bit on the weak side. So we still think oil should have one more major retrace. As much as we see potential for much higher prices in the longer term, over the next 2-3 months, we probably think something with a 4 in front will be happening, even a bit lower, maybe the mid-40s. We don't wish that, we don't see it that realistic, but 48 definitely. As far as gold goes, I think it's now in a different cycle. I think it's basically helped with the likes of copper and your industrial metals such as iron ore. And the technical outlook has improved tremendously. If you look at gold stocks, if you look at, for example, one that we like to look at a lot because it sort of illustrates more your speculative gold investments, is the Fennec Vector Junior Gold Miner ETF. That's given us an outright major buy signal on the long term. So that to us is a good indicator that gold and the precious metal sector is on the way up, and potentially very strongly so. Whereas oil is lagging behind, might even contract for a period, and probably joins the likes of gold and copper in a mid-year period, but we don't see much before.
Does that oil story, I mean, you say they're sort of lagging behind, how much of the US dollar story is flowing into that? Because it seems like that bull story is on hold for now, if not being sort of stored away for a little while.
Well, that's right. I mean, the US dollar, as a matter of fact, after an 8-year rally, shows a weakness. Obviously, last month was a pretty weak start to the year. We think probably on crude oil, the dollar factor has not been a big factor, as we basically range trade within a 5% range on the index over the last few months. Really, it's the individual fundamentals on oil, as we all know, the supply and demand story. We're still skeptical in the US of seeing all these frackers come back en masse, simply because there's been far too big of a fallout of them all blowing up. And I mean, that's only a couple of years ago. So that needs still time to be digested by the likes of the banks who gave them money and investors at large. But we do believe it needs a $60 level plus for US fracking to come back more and will have more of an impact. But oil itself, at this point, also has been looked at from the demand side. That's been steady and steadily rising, albeit at a lower pace. So really, it's lagging behind, and the supply-demand scenario will have to work itself out. And I believe now it will take a little longer than what we thought initially. Mid-year still looks like a pretty good basis. So by March, April, I would expect oil and gas price to offer potentially tremendous entry levels on the long side.
Are you looking at any of the oil plays right now? Obviously, we're just about to come into reporting season, so we're looking at, well, a lot of those key themes being that you know, cost reduction continuing and potentially special dividends, capital management. Are there any of the oil plays that you like?
Well, I think, yes, I do. Woodside is a conservative play. It just soldiers on nicely, boringly, but nicely, and is definitely a good conservative hold. I think we looked at Santos over many months, and to me, it just got... If you look at Santos on the balance sheets, you look at where they are price-wise, the whole business as such, to us, Santos actually could be a potential takeover target. It's just a classical stock that's up for the taking. So I think that's something to watch. So if people want to have a long exposure to oil with a bit of gearing, a bit of oomph attached, I think Santos is definitely the one to be in. Internationally, the big ones, I would really stay clear. They were a bit ahead of the Australian oil stocks, and I just can't see any positive signs there in the moment. They had a good run. They need a correction. We need to let it all play out. So I think I give it a couple months and see how it looks then.
Excellent. Now, just speaking of these oil plays, I want to get a thought from my panel. In fact, we've had a question coming in from a viewer, Chris, in fact, from Sydney, saying, "Hi, guys. For once I got my timing and conviction right, and I bought Origin Energy a year ago. It was just under $4. I still believe there is upside for Origin. I can't find anything else compelling to invest in. However, it's now 60% of my portfolio, so I'm concerned about the single stock exposure. I'd really like the panel's view on Origin over a 2 to 3 year horizon." So what is Origin? About $7.15 right now. What's your thought on this stock?
Yeah, so for us, we did buy some more down at that sort of $4 and $5 mark, but we did have clients in at a lot higher prices, so we were just averaging down for the position. That was the right move. It's now started to move in the right direction, and obviously the market's getting behind because there is going to be an asset sale or an IPO sometime this year, so the market is getting behind that a little bit. However, 60% of your portfolio, I would be very, very careful, and I would reduce that exposure to at least a 10% exposure. We don't usually like to have more than 5% of any one stock in exposure, and probably energy sector you'd like to have at least 10% in an overall portfolio. So I'd be a little bit careful with the exposure side, but I'm still happy with Origin.
Certainly, Rudy, you don't want to be putting all your eggs in one basket, do you?
60%. I think I just had a heart attack. I mean, those things, they always work when they work out, and when they don't, you're really going to regret it. Right? And I mean, the obvious thing to say, not one single stock is risk-free, and in particularly not the one that's called Origin. Having said so, if you want to, I mean, I would take profits anyway, but if you're looking at buying in, I would definitely wait for cheaper prices, because I think the outlook for oil prices in the short to medium term is a little bit murky now. So we probably are looking at lower prices, I think. And share price, like the ones of Origin, can pull back a lot, because the fact that they are going to sell or trying to offload their exploration business, that's also dependent on a high oil price. You get more. And if the timing is incorrect, then they will get less, and that will reflect in the cheaper share price as well.
Okay, all right. Things to be mindful there for Origin, $7.14 right now. So appreciate that question coming from Chris. Markus, just back to you. I want to get your thought on the iron ore price. You alluded to it a little earlier. Look, a lot of sort of defied the skeptics, I should say. It's still holding up. It's so resilient at these levels. How does the story look to you right now? Can we maintain that resilience?
Sorry, Leanne, I didn't hear the initial product you mentioned.
For the iron ore price.
All right, sorry. Well, look, to us, obviously, it's purely China-related, and to some secondary degree, what Trump is going to come forward with his infrastructure ideas and all that. I think probably the important part is about, talking about Trump and the US, is how he's going to structure the financing of major infrastructure projects. If he comes forward with a viable public-private type scenario, you could find that would be very well received by the equity markets as well as the commodity markets. If it's a purely sort of China-style public finance, debt finance scenario, I think that'd be a real struggle to be digested. And I mean, that's really what's still happening in China. And let's not forget, we have all this boom based on the likes of China going to more debt to build more projects that they really probably don't need. So long term, we are very concerned, but in a moment, we think we should all enjoy it while this show lasts and while we have a positive story to enjoy. And the longer that lasts, the better, because the alternative is simply not that fantastic. As a matter of fact, the alternative will be pretty grim. So I really reckon in a moment this is to be enjoyed and to go with it, albeit critically, and that's what we do.
All right, fantastic. On that note, I think we'll wrap it up there. Markus, it's been wonderful having you on. Do appreciate you joining us, and we look forward to talking again soon.
Thank you, Leanne.